Silver just got hit with a 3.3% drop today, closing at $80.54 an ounce. And while most people are treating that number like a warning sign, I want to show you exactly why it isn't. Because at the exact same moment that price was falling on your screen, China was sitting on a $214 billion trade surplus, the largest they have posted in over a decade, and they are not putting it into U.S. Treasury bonds. Saturday, March 14th, New York time. Comment your date below so I can see where you're watching from. If you value this work, subscribe and comment George Williams. It really helps. Now let's talk about what is actually happening here, because the surface level reading of today's session is completely wrong. The spot price touched $79.54 at the low and peaked at $85.61 before pulling back to close at $80.54. COMEX May futures settled at $81.13, down 0.99% on volume of 43,500 contracts, with open interest sitting at 77,900. Those numbers look like a bad day, and if you only watch the paper market, you would think silver is struggling. But the paper market is not where this story is being written right now. The story is being written in Beijing, in trade ledgers, in commodity warehouses, and in the fundamental supply and demand data that almost nobody in mainstream financial media is connecting together. So let me do that for you right now. Start with the year-on-year picture. 12 months ago, silver was trading at $29.12. Today, it is at $80.54. That is a 161% increase in 1 year. 1 year. And on January 29, 2026, silver printed an all-time high of $121.62. The 52-week range runs from $29.12 all the way to $121.79. What you are watching today is not a broken market. It is a consolidating market. There is a difference. And the people who understand that difference are the ones who position correctly before the next leg. So why did it pull back from $121 in January? Because markets do not move in straight lines. They breathe, they reset, they shake out the people who bought on emotion rather than on fundamentals. And right now, with the RSI sitting at 51.1, dead neutral, and the ADX at 20.9, which is technically below the threshold that indicates a strong trend, you have a market in a consolidation phase, not a breakdown. Key support is holding between $79.70 and $80.33. The price closed right on top of that zone today. Resistance is sitting at $83.98 to $84. That is the technical picture. Clean, defined levels, not chaos. But technicals are the last thing I want to spend time on today because the macro story dwarfs everything happening on the chart. Let me walk you through it piece by piece. China just posted a $214 billion trade surplus. Think about what that number actually means. It means China sold $214 billion more to the world than it bought. That is an enormous pile of foreign currency, predominantly dollars, that has to go somewhere. And here is what has changed in the last 2 years. China is no longer recycling those dollars back into U.S. Treasury bonds at the pace it once did. The old mechanism, where surplus dollars flowed back into American debt and effectively funded Washington's spending, is breaking down. Instead, China is rotating that surplus capital into physical assets: gold, copper, rare earths, and silver. Particularly silver, because silver sits at the intersection of two things China cares about more than almost anything else: monetary protection and industrial dominance. That shift in capital flows is not a theory. It is visible in the data. Central bank gold buying globally has been at multi-decade highs for 3 consecutive years. Commodity stockpiling in Asia has been accelerating, and the physical silver market is tightening in ways that the paper futures price has not yet fully reflected. That disconnect is the most important thing to understand right now. Let me explain what is happening with silver supply, because this is where the story becomes truly structural. Silver is in its 5th consecutive year of supply deficit. 5 years in a row where the world has consumed more silver than it has mined. The cumulative shortfall over those 5 years has reached 820 million ounces. That is not a rounding error. That is a structural, multi-year imbalance between what the ground produces and what the world demands. Global mine output is running at roughly 850 million ounces per year. That sounds like a large number until you understand what demand looks like now and what it is projected to look like by 2028. Industrial demand for silver alone is projected to exceed 1.2 billion ounces per year by 2028. 1.2 billion ounces, against 850 million ounces of annual production. That is a deficit of 350 million ounces per year that has to be sourced from somewhere. From above-ground stockpiles, from recycling, from investor liquidation. At a time when investors are not liquidating, they are accumulating. Right now, 85.8% of retail CFD traders are net long silver. The market is not selling. The market is holding and buying. And here is the other side of the supply equation that almost never gets discussed. You cannot simply flip a switch and produce more silver. Fresnillo, the world's largest primary silver mining company, just cut its 2026 production targets. The biggest player in the game is producing less, not more. And if you wanted to bring a brand new silver mine online tomorrow, you could not. The permitting and development process for a new mine in any Western country takes between 7 and 15 years. Environmental reviews, regulatory approvals, infrastructure build-out, the timeline is measured in decades, not quarters. So even if the silver price doubles from here, new supply cannot respond meaningfully for the better part of a decade. The market is structurally tight, and it is getting tighter. Now let me connect that supply story to the demand story, because this is where it gets genuinely staggering. More than 60% of annual silver demand is industrial. This is not jewelry. This is not coins. This is manufacturing. Every electric vehicle requires between half an ounce and a full ounce of silver embedded in its electrical systems. The contacts, the circuits, the battery management components. Every single solar panel requires approximately 20 grams of silver. Every 5G cell tower requires specialized silver components for signal conductivity. The semiconductor industry, which is the backbone of everything from smartphones to AI data centers, uses silver extensively in its fabrication processes. Now stack those numbers against what the energy transition actually looks like at scale. The International Energy Agency projects hundreds of millions of EVs on the road by 2035. Solar installations are being built at a pace that was considered impossible 5 years ago. 5G infrastructure is still in the early innings of global deployment. AI data center construction is accelerating at a rate that is straining every input commodity from copper to silver to rare earths. Every one of those build-outs requires silver, and the supply to meet that demand does not exist yet. China understands this math better than anyone. They are not buying silver because they think the dollar is going to collapse next Tuesday. They are buying silver because they are building the infrastructure of the next 50 years of economic output, and silver is a non-substitutable input across most of those applications. When you have a $214 billion surplus to deploy, and you understand that silver production cannot meaningfully increase for a decade, while industrial demand is set to exceed production by hundreds of millions of ounces annually, the trade is obvious. You accumulate physical metal while the paper price is still in consolidation. And the paper market is giving you a signal right now that most people are completely missing. COMEX is in backwardation. That is a technical term that means the price of silver for immediate physical delivery is actually trading at a premium to the price of silver for future delivery. In a normal, well-supplied commodity market, the opposite is true. Futures trade at a premium to spot because of storage and financing costs. When that relationship inverts, it means the physical market is tight. It means buyers who need metal now are willing to pay more for it than buyers who are willing to wait. Backwardation in silver is not a regular occurrence. When it appears, it signals genuine tightness in physical supply relative to immediate demand. And it is happening right now, while the spot price sits at $80. There is one more valuation signal worth paying close attention to, and that is the gold to silver ratio. Today, the ratio sits at approximately 62 to 1. That means it takes 62 ounces of silver to buy a single ounce of gold. The historical average for this ratio over the last century runs between 70 and 90 to 1. The fact that the ratio is currently below the historical average means silver has already re-rated significantly relative to gold over the past year. But it does not mean silver is expensive. It means the market has started to recognize the supply and demand dynamics we just walked through. Whether the ratio continues to compress, stabilizes here, or reverts toward the historical mean depends on how the macro story unfolds from here. Which brings me to the 3 scenarios I think are worth mapping out clearly right now. In the bearish scenario, silver pulls back into the $60 to $70 range. What would have to happen for that? a sustained and significant strengthening of the US dollar that reduces commodity prices broadly, a genuine and sustained decline in inflation that allows the Federal Reserve to tighten monetary policy aggressively, a slowdown in Chinese industrial activity severe enough to reduce EV and solar panel production meaningfully, and a reversal of the institutional accumulation trend. That is a heavy list of conditions. Not impossible, but it would require several major macro tailwinds to reverse simultaneously. JP Morgan's base case forecast for 2026 sits at $81 per ounce on average, which at today's price suggests they see limited upside, but also limited additional downside from current levels. In the base case scenario, silver trades in a range between $70 and $90 for the remainder of 2026. Consolidation continues. The supply deficit persists. Industrial demand grows, but at a measured pace. The macro environment remains mixed. Some dollar strength, some inflation uncertainty, continued geopolitical tension but without a single catalytic event that reshapes capital flows. In this scenario, silver grinds sideways to slightly higher, building a base that sets up the next directional move. This is actually the scenario the technical data supports right now. Neutral RSI, weak trend reading on the ADX, support holding, a market waiting for its next catalyst. In the bullish scenario, silver breaks above $100 and tests the $135 level and potentially beyond. Bank of America's published bull case for silver in 2026 runs from $135 to $309. Alan Hibbard at goldsilver.com has a full-year target of $175 and above. For the bull case to materialize, you would need a combination of the Federal Reserve pivoting meaningfully toward rate cuts, which weakens the dollar and increases the attractiveness of hard assets, a significant acceleration in Chinese commodity buying as that $214 billion surplus gets deployed into physical metals, a further tightening of COMEX physical inventory, and continued growth in EV and solar demand that makes the 2028 industrial demand projection feel like an underestimate rather than an overreach. All of those conditions are plausible. Several of them are already partially in motion. The question is timing and velocity. Here is what I want you to take away from everything we just covered. Silver at $80.54 today is not a broken trade. It is a market at a technical decision point, sitting on support, against a backdrop of one of the most compelling structural supply-demand setups in the commodity market right now. The fifth consecutive year of deficit, 820 million ounces of cumulative shortfall, industrial demand set to exceed total global production by 2028, the world's largest silver miner cutting output targets, the largest surplus economy in the world rotating out of paper assets and into physical commodities, COMEX in backwardation, a gold-to-silver ratio below its historical average. These are not opinions, these are data points, and they are all pointing in the same direction. I am not here to tell you what to do with your money. That is not what this channel is about. What this channel is about is making sure you have the information that the mainstream financial media consistently fails to connect and contextualize for you. So do your own research, read the supply reports, understand the industrial demand projections, watch the COMEX inventory data, follow what China's sovereign wealth apparatus is actually doing with that $214 billion surplus, because it will tell you more about where this market is heading than any Friday afternoon price tick on a futures screen. If this kind of analysis is useful to you, subscribe and hit the notification bell, because the macro picture here is evolving fast and I am going to keep tracking it. And I want to hear from you directly. Drop it in the comments right now. Where do you think silver is trading by the end of 2026? Give me your number. Bear case, base case, or bull case. Let me know where you stand, because this community sees things that the rest of the market is still figuring out. I will see you in the next one.